Virus broke mortgages. COVID-19 is a novel strand of the coronavirus, meaning it has not previously ever been seen in humans. It was first reported in Wuhan, China on December 1st, and the virus began spreading from human to human transmission. Without previous infections to humans, there's no antibodies that can combat the virus. For some, the illness can lead to pneumonia in both the lungs, multi-organ failure, and even death. With COVID-19 now classified as a pandemic, economies have come to a standstill. Financial markets have been turned upside down in ways that make the Great Recession of 2008 pale in comparison in many areas. February 2020, as the coronavirus continued to spread rapidly, investors began rebalancing their portfolios to less risky assets, such as treasuries, bonds, and mortgage-backed securities. This, as many of us know, helped mortgage rates drop briefly and some to the lowest point in history, which caused a tidal wave of refinance applications. However, based on the simple theories of supply and demand, the demand for refinance loans was higher than the support that the mortgage companies could offer, leading to an overcapacity at both lenders and banks. And just like toilet paper disappearing off the shelves due to high demand, low mortgage rates disappeared almost overnight as lenders raised rates to try to slow the flow of applications. Many banks and institutions stopped even taking refinances, or even in the cases of some banks like Navy Fed, are telling clients it's 150 to 180 days to close a simple refinance. As banks and lenders funded billions of dollars in mortgages to sell on the mortgage-backed securities, others also sold these assets to raise capital, to put additional cash on their balance sheets, which caused the secondary markets to become flooded. The oversupply of mortgage-backed securities meant buyers were not purchasing the assets as quickly as they hit the market. And just like anything else, when there's an oversupply compared to the demand on market, it caused deterioration in prices, meaning the prices of mortgage-backed securities coupons plummeted, which means the inverse relationship between price and rate, thus caused mortgage interest rates to spike. The drop-off in the value of mortgage-backed securities caused mortgage rates to spike as much as 1% to almost 2%, depending on a lender, in simply a matter of a few days. As the government began issuing social distancing orders, businesses were forced to close, lay off millions of workers, or move to a less efficient model of working from home. The fear of the illness turned into a major economic concern as analysts realized that homeowners without jobs may not be able to make their mortgage payments. The Federal Reserve comes to the rescue, but due to their not full understanding of the mortgage market, they began to be worried about the effects of the coronavirus and started implementing social distancing and the closure of businesses. The lower risk of major long-term recession, they made an emergency meeting where they dropped the Fed funds rate to near 0%. Now, the Fed funds rate is the rate at which banks can borrow overnight from one another to cover withdrawals and other obligations. News outlets, however, made the terrible misrepresentation that mortgage rates were 0%. Now, that's not true, as it was the Fed funds rate that was at 0%, which caused thousands and thousands of homeowners in each city flooding to the market thinking mortgage rates were at zero. Homeowners began frantically calling their mortgage companies to refinance, thinking all mortgage rates were at 0%. As refinance applications jumped, mortgage servicers began to panic. Once a loan is closed, the way a mortgage works is the servicer buys the mortgage servicing rights, which is the ability to collect mortgage payments and then pass them on to the end investor. And they receive a fee for doing that or servicing the mortgage. Now, in order for the fee to be recouped, that they go ahead and actually pay to service these mortgages, they must have at least hold that mortgage for 3 to 4 years worth of collecting mortgage payments to break even. And the longer the mortgage goes with that servicer and having those payments, the more profit they're able to do so. So a typical mortgage servicer needs to make sure that they keep that mortgage for somewhere between that 3 to 4 year range to break even and then move towards profits. Now, if a client refinances, there can be some major losses for these servicers due to potentially early payoffs. So if a client refinances that loan within a year or even 2 years, these mortgage servicers lose thousands of dollars, and can cause some serious issues in the mortgage financing spectrum. Now, as these payoffs become earlier and as both interest rates go down, there's less value to the servicing because there's a greater risk of people refinancing that mortgage. If a original mortgage is given at 4% and interest rates go down to 3%, the chances of that person keeping that 4% mortgage loan for 3 to 4 years is very unlikely, which is devaluing the actual mortgage servicing portfolios that these banks have. This compiled with default rates due to people losing their jobs or wanting to enter into forbearance agreements, the higher the chance of default, compiled with a drop in interest rates, really substantially devalues these mortgage servicing portfolios, which puts an extreme strain on mortgage banks and mortgage lenders. Now, people need to understand that mortgage rates are not set by the Fed. They're priced on several factors, including the value of these mortgage-backed securities and mortgage servicing rights. Now, as a flood of refinancing hit, the value of both the mortgage-backed securities and the mortgage servicing rights dropped at unprecedented rates, meaning the value of holding the mortgage drops, which causes mortgage rates to jump up and down rapidly. High mortgage rates in a slow economy would be absolutely disastrous, the absolute worst thing that could potentially happen to somebody's largest asset. So in an attempt to drive mortgage rates back down, the Fed announced, which we're all very familiar with, a major bailout package, which included the daily purchase of billions of dollars of mortgage-backed securities, a level that we have never even seen even during the great financial crisis of 2008. Now, we're all familiar with the game of hot potato. Nobody wants to be left with the hot potato at the end of the game. It means you're out. With the Fed buying billions of dollars of mortgage-backed securities at levels never been seen, the mortgage-backed securities value began to come back and in theory should drop mortgage rates. However, the problem is the Fed plans to overlook some of the unintended consequences to these mortgage lenders and services. If rates drop too rapidly, they lose a significant amount of money. Obviously being the fact is if rates are plummeting downwards and these mortgage servicing companies have billions of dollars worth of loans at 3.5% to 4% and interest rates fall down to 3%, there's a high chance of all those loans being refinanced before that 3 to 4 year window break-even point. And what people don't understand is lenders have major costs from hedging the markets, meaning they have to take the other side. If they are going to receive a mortgage loan and say they lock that loan, they don't really in most cases actually lock that loan until the time of funding. Now what that happens is they have to hedge to make sure that if the market moves against them, that they are in a position to still be able to fund that loan at that offered interest rate. Hedging has caused the people and banks to lose and have to contribute huge sums of cash. And these cash many times have to be borrowed at higher rates. Lenders then have to pass on those costs in the form of higher mortgage rates, leading to larger margins in many cases. Mortgage servicers then lose value due to mark-to-market for accounting, and they slash these asset values, leading to the need for dramatic access to additional capital to be able to stay in the business. The Fed bailout packages did not address the fact in the stimulus plan on how these additional payments are going to be covered if homeowners are unable to make their mortgage payment. Because even if the homeowner does not make the mortgage payment to that mortgage servicer is required to cover that mortgage payment to the end users. So they could be obligated in many cases to pay billions of dollars in payments from payments they are not receiving from those homeowners. So even $1 billion in servicing rights, if those $1 billion of loans are in forbearance or do not receive payments, and even if they own $100 billion worth of servicing, just 1% of default ends up being about $49 million a month in cash outlay that they are not receiving. So you can imagine at a default rate of 10% on what will actually potentially happen. Ultimately, the government has created an environment where mortgages have become that hot potato, and the ones left holding it at the end to collect those mortgage servicing could be significant losses or potentially even bankrupt. In the face of this economic slowdown, Congress has also gotten involved with the fiscal policy, saying we need to help homeowners with these mortgages and covering these payments. However, before the systems and plans were even finalized, several people encouraged homeowners to call their mortgage company and to skip mortgage payments, which is completely wrong and should never be done before these plans are finalized. It was running rampant through the internet, and in many cases, we're only going to be self-fulfilling a greater recession. With the high potential of default risk, the mortgage industry has reverted to tactics we've seen back in 2008. Banks and lenders began tightening guidelines and in many cases adding additional overlays or discontinuing products to make sure that they protect their interests during this tough time. The non-QM or portfolio market, better known as stated income loans or bank statement programs, has nearly collapsed within a week and has actually caused several companies to close their doors. Jumbo loans, which is any loan amount over the conventional loan limit, has become increasingly difficult to obtain, and many banks and lenders are no longer offering lower down payment jumbo loans, and they are now requiring larger down payments, and the spread or rate difference between a conventional loan and a jumbo loan is ever increasing. Now, the farthest reaching changes are for Ginnie Mae. And what Ginnie Mae is, that is the government-backed mortgages that include FHA, VA, and USDA loans. These loans are designed to typically help borrowers that have lower credit scores or lower down payments. Now, the coronavirus has caused the perfect storm for the mortgage markets. The combination of volatility and unintended consequences from the government has left mortgage lenders and servicers reeling. Until the storm calms down and the coronavirus is better controlled or the exact damages are better known, we're going to see continued restrictions on these loans, where less people, just in the interim, qualifying potentially for mortgages or the amount they qualify for should be better viewed in a conservative mindset. Now, don't worry, there is good news coming. Once the financial markets begin to recover, many economists believe that there will be a rapid bounce back. Before the coronavirus hit, the underlying economy and housing market was extremely strong, with extremely low, historically low interest rates, stable house prices. The lowest unemployment we've seen in 4 decades has led to businesses being thriving and historically low unemployment with historically high consumer confidence. Now, the government will need to inject cash into the consumer's hands to stimulate the economy and promote growth, as it is our own spending within the residents and citizens of the United States that is the biggest driving force of our economy. To do this, they will continue buying mortgage-backed securities, which will keep mortgage interest rates low for the next year to 2 years. The U.S. Treasury Secretary and Ginnie Mae have already begun working on solutions for short-term liquidity issues of lenders and servicers to calm this market volatility ahead. Now, this will lead to windows of time that you will be able to lock in historically low interest rates, and both on the purchase and refinance set. For now, let's all pray for a treatment and a cure for the coronavirus, and each and all do our part to slow the spread down by social distancing and staying at home. A huge appreciation for the beautiful article written by Anthony Bird, mortgage broker and owner of Riverbank and Finance. Stay safe, stay home, and stay healthy.